Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights on this program, we discuss various perspectives shaping the global investment landscape. The universe of persistently high inflation, the universe of slowing growth, the universe of lingering virus, the universe of rising geopolitical risks, and the universe of central bank tightening have all collided, causing a great deal of chaos in financial markets. As we know, financial markets are notoriously famous for their inability to focus on more than one risk at a time. Therefore, when confounded by a range of risks, financial markets tend to become volatile, purely reflecting the uncertainty. During such periods, the bearish sentiment dominates even the relatively strong fundamental picture, and it is easy to be bearish at a time when asset prices are falling. This further exacerbates the weakness in financial markets, and this has been the story so far this year, where investors had to navigate the multiverse of bearishness. At this juncture, we might be close to or even at the point of maximum pressure on financial markets, where a range of headwinds are all blowing at their maximum speed. Looking ahead, we should expect the headwinds to abate and provide the much needed relief for financial markets. However, this process is likely to be gradual and spread over a period rather than achieving relief overnight. Sequencing of abating headwinds will determine the speed and nature of the market performances looking ahead. To start with, the immediate relief can be got from falling COVID-19 cases in China. With number of new COVID-19 cases starting to fall in both Shanghai and Beijing, markets might reassess the outlook for not only the Chinese economy and assets, but also of global trade and supply side bottlenecks. Given China's economic size and contribution to the global economy, some of the concerns associated with global growth faltering could start to abate. Over the course of the next 2 months, the focus is likely to remain on persistent inflation across the board. Inflation in the US has been monitored closely by the markets, and there we're likely to see some moderation in the inflation from the current multi-decade high levels. While we're not forecasting the core inflation in the US to fall below the Fed's target this year, any moderation of inflation from the current levels should help markets reprice not only the economic damage caused by the high inflation, but also the path of the monetary policy in the US. Beyond that, the focus is likely to shift from inflation to growth. Here, while we're watchful of downside risk to global economic growth, we're not worried about a recession at this stage. However, acknowledging the uncertainty around the global economic trajectory, we take a scenario-based approach and define 2 scenarios. The base case scenario with higher probability sees a mid-cycle slowdown, and the worst case scenario with lower probability sees a recession. Reflecting this, we've recently made some adjustments to our portfolio positioning. For details, please take a listen at last week's podcast titled Watchful, Not Worried. As markets navigate risks around growth and inflation, perceptions about the monetary policy are likely to remain fluid and at the fore. Discussions about how fast the central banks need to raise rates, how fast they should shrink their balance sheets, and where the neutral rate for their economies is, and whether the peak rate should be above the neutral rate are all likely to be dominant. Here, we stick with the view that as long as the central bank policies remain appropriate to the evolution of the growth inflation mix, financial markets should be able to digest even tighter monetary policy. We see the recent rise in geopolitical risks as one episode in the long-term trend of deglobalizing world. Globalization has driven strong economic gains over the past couple of decades, but a period of hyper-globalization, slow-lane globalization, or deglobalization, whatever one might choose to call it, will dominate over the next 10 years. Yet any improvement in the Russia-Ukraine situation is likely to be near-term positive for risk assets. All these developments with risks discussed so far are likely to play out over different time frames and are likely to influence performance of various assets. For instance, moderating inflation and slowing growth should be positive for the long end of the US Treasury yield curve and long duration assets within equities. Slowing growth, even without a recession, would mean outperformance of defensive sectors versus cyclicals. Even within growth equities, non-cyclical growth equities are likely to outperform cyclical growth equities in an environment of slowing growth. European assets that have seen sharp declines in their value since Russia's invasion of Ukraine are likely to see a relief rally if and when the situation improves. In summary, we might be close to or even at the point of maximum pressure exerted by a range of headwinds on financial markets. This is reflected in extreme bearish risk sentiment. For instance, the 4-week average of net bullish readings on American Association of Individual Investors survey has recently dropped to levels only seen during the peak of recession fears in the past. Peak recession fears, peak inflation, peak COVID-19 cases in China, peak hawkishness in monetary policy, and potential peak in Russia sanctions are the precursors of a strong risk asset rally. However, these are likely to play over different timeframes and influence performance of various assets in distinct ways. Thanks for listening. We hope you found this podcast useful. For more information on what was discussed on this podcast and to understand in detail what the path we described in this podcast would mean to your portfolios, please reach out to your ADCB relationship manager. You can also log on to our website at www.adcbam.com for more information. My name is Kishore Muktinutalapati, and I will be back next week with more global investment insights.